We've just entered the next phase of the global economy. Take a look around. Central banks across the globe are cutting interest rates. The Federal Reserve, Canada, China, and several European countries are all reducing their rates. Typically, when central banks lower interest rates, it's a move to stimulate the economy. By making borrowing cheaper, they encourage consumers and governments to spend more. On the other hand, some countries are preparing for economic uncertainty by purchasing precious metals. For example, China, Russia, and India have all ramped up their gold buying recently, which has contributed to a significant rise in gold prices over the past year. Now you may be wondering, what's happening here in the United States? Let's start with the Federal Reserve. According to its website, the Fed does not own any gold. This is due to the Gold Reserve Act of 1934, which required the Fed to transfer all its gold to the U.S. Treasury. As of 2023, the U.S. Treasury holds more gold than any other country. Before we go any further, I need to give you a quick disclaimer. I'm just a guy on YouTube. Investing comes with risks, and you're not guaranteed to make money. In fact, at some point, you will lose money. So always do your own research and don't blindly follow anyone's advice online, including mine. I've been buying gold for years, but it's always been a small part of my portfolio. I don't like the fear-mongering tactics that some gold salespeople use, urging people to panic buy gold because they claim the dollar will collapse. If you want to invest in gold, make sure it's a rational decision, not one based on fear. Now let's focus on three important things. 1. How these global economic changes are impacting currencies. 2. How they're affecting markets around the world. And 3. How does this all impact you? Let's start with the first point, currencies. The US dollar is a fiat currency, meaning its value is derived from the fact that the government says it has value. It's not backed by gold or any other physical commodity. In the past, US dollars were backed by gold, but that changed over time. In 1933, President Franklin D. Roosevelt signed an executive order that made it illegal for Americans to own gold. The real turning point came in 1971, when President Richard Nixon took the U.S. off the gold standard entirely. This meant the government no longer needed to hold gold reserves to back the amount of money it printed. Since then, the dollar has been a purely fiat currency. So, what's the consequence of this? One major effect is inflation. Inflation occurs when the money supply increases without a corresponding increase in economic output. We've seen this play out over many years, and while the Federal Reserve targets an inflation rate of around 2%, inflation has been slowly eroding purchasing power for decades. Picture this. The US government generates $1 trillion in taxes. Ideally, it should spend less than that amount and save some for emergencies. However, the government typically spends more than it collects. Let's say $1.2 trillion. So where does that extra $200 billion come from? The government borrows it. They can borrow from people like us, other countries, or the Federal Reserve, which now has the ability to print money since the dollar is no longer backed by gold. This enables the government to spend more money, stimulating the economy by hiring people and funding projects. But this also leads to inflation, which is the trade-off. If the government can print money, why do we still pay taxes? Well, printing too much money causes inflation, so taxes help limit the amount the government has to borrow. But with national debt rising and the government spending more than it brings in, inflation has become an increasing concern, especially over the past few years. To understand how interest rate cuts affect markets, let's look at history. While rate cuts are meant to stimulate the economy, they don't always lead to a rising stock market. For example, in 2020, the Fed cut rates by 1.5% and the stock market went up by 16%. In 2019, rates were cut by 0.75% and the market rose by 28%. But in 2008, during the Great Recession, rates were cut by 4.75% and the market still fell by 38%. This brings us to what you should do as an investor. There are 3 questions you need to ask. 1, what is your strategy? 2, what is your goal? 3, what assets are you investing in? If you're a passive investor, you can use a set it and forget it approach, investing in things like index funds or ETFs consistently over time. This is called dollar cost averaging. On the other hand, if you're an active investor, you'll be looking for opportunities to buy assets when they are undervalued. Next, understand your goal. Are you investing for cash flow or for appreciation? For me, I focus on cash flow, and most of my investments are designed to generate income, like dividend-paying stocks and real estate. Other people might prioritize growth or appreciation. Finally, consider your assets. Do you want to invest in stocks, real estate, or both? I invest in 5 main areas: my business, real estate, stocks, both passive and inactive, speculative investments like startups and crypto, and gold. Gold is a small part of my portfolio, more as an insurance policy than an investment. Your job is to stay informed about what's happening in the economy and be a long-term investor so you can spot opportunities to build wealth.